Hello, everyone. My guest today is Brad Miller. He's a serial entrepreneur who successfully bought, built, and sold several companies with extreme capital efficiency. Most recently, grew Awareness Technologies revenue 400% organically and through acquisition with a 37% EBITDA margin, with investors making a 9x ROI. Previous to that, he built Silver Sky from startup to 60 million in revenue with 10 million in EBITDA. After recapping with Goldman Sachs at 150 million bucks, it was later sold to BAE for 250 million dollars. This guy knows what he's doing. Brad, you ready to take us to the top?
Sure, shoot.
All right. Tease people first. We already interviewed you several times as you were building Awareness Technologies, but quickly talk about the capital infrastructure behind Awareness Tech. So did it start off as a search fund? How did you get the deal done?
After I did the deal with Goldman at my previous company, Silver Sky, we had been buying companies, and at some point, they didn't want to keep buying companies because they felt like we were going to become viewed as a consolidator rather than an organic grower. And so there were companies that I wanted to continue buying, and they didn't want to. So I asked for permission to buy the ones that I was looking at that they passed on, and so I left. I left Silver Sky and then bought Awareness Technologies with another financial partner, and that's kind of how it happened.
That's great. So when you structured that initial deal with that first financial partner, did they have equity in the company, or was it pure debt?
No, they were. We were 50-50 equity partners. We each put up 2.75 million. We put up 5.5 million together. All that money went to founders. It wasn't money in the company. The founders, I may have told you this, went on to take that money and start a $1 billion company called Quest Nutrition. I don't know if you're a fan of Quest bars.
Love Quest bars.
Yeah, and but the business when I bought it was doing sort of 5 million, losing 1 million. And even though it was structured as a SaaS cloud delivery model, they were only charging a one-time fee, though providing service and cloud forever. And so the first thing we did was change that to a subscription. And so the business went from 5 million, losing 1 million, to 7 million, making 1 million, because the extra $2 million of immediate revenue was pure profit. And then we just kept going from there.
What year was that?
That was 2010.
And so take us through the journey. You get a little bit of incremental revenue the first 12 months. What happened in 2019, 2020?
We bought a few businesses along the way. We kind of were leveraging profits, both to pay dividends as well as to use EBITDA for bank debt purposes to acquire a few companies. And so we bought we were both in the consumer business and the B2B business. We bought a consumer business and a B2B business, each one for 3 million, one for 3.5 million. Anyway, the business grew from 7 million, well, I guess 5 to 7, and then to 20. Last year we did 20 million, making 6. And so that was big. It was a big year. There was a lot of growth in our B2B business due to the COVID effect. We focus on providing employers with PC activity, monitoring activity of their employees. So, what time do they log in? What are they doing when they log in? How do I get comfortable that all the things that I used to see with my eyes when people came to the office and I no longer see, how do I recreate that line of sight information I used to have? And so we had the B2B business had a very big year last year, and so it was a good time to sell, and so we did.
I want to talk more about timing, but just to sum that up, 5.5 million to start of your guys' own cash, another 3 million, then another 3.5 million. So about 11 million into the business total, but enterprise value in terms of actual revenue was, call it 25 million. I mean, this is extreme capital efficiency. What enables you to spot like these sorts of things where there's not a bunch of other competition? I imagine other people look at this and go, we should do the same thing, and then you can't buy it because there's so much competition. How did you find these gems?
Well, one of the competitor that we bought, sometimes it's just being at the right place, right time, but the last competitor that we bought that pushed us over the edge to 20 million. I looked at buying a year before I bought Awareness. And when I looked at buying it, I couldn't afford it. It was doing 15 million of revenue, making 6. The two VCs bought it for 45 million, and the business went from doing 15 million, making 6, to doing 7 million, losing 3 when we bought it. So it's why we bought it for such a good deal. But when I saw them, I was like, this is back in 2008, 2009. I was like, wow, I don't know many internet security businesses that are growing 20%, doing 15 million, making 40% EBITDA margins. And when I saw Awareness, it was, they were the Avis to to that company's Hertz, if you will.
Yep.
And I was like, geez, and so it was a 2-horse market at that time between the two of them, where the number one company was 3 times the size, but you could see how you could, take up some of that market share. And I felt if we could just even grow it to 10 million, we'd go from, making $1 million once we added the recurring revenue to making 4 or 5 million. And if you could buy a business for 5.5 million and make 5 million, those are good numbers. Little did we know along the way that company would have such problems. And so,
did you have an in with the VCs that bought it for 45 million, where they were happy to take the loss and let you take it, even though you win?
My co-investor co-invested with one of those VCs in another deal, so we had an initial entree into that conversation. They were for sale for 2 years. They didn't contact us. They viewed us as the small guy nipping at their heels and not able to afford them. And their business was doing better before they, at the beginning of their sales process, but it started to really struggle in the last year.
Mm-hmm.
And they kept thinking it was going to turn around, and it didn't. And so we did a deal literally in 3 weeks because
Wow.
They weren't going to be able to meet payroll. They were burning cash fast and not willing to do anything about it. And they kept hoping for some big deal to close, and it didn't. And they needed to get something done. And the VCs had guaranteed a $2 million emergency line of credit that was due at the same time, and they didn't want to make good on it. So we were able to basically buy it by taking over that $2 million line of credit, and then pay the investment banker fees and lawyer fees that they couldn't afford to pay because there was no cash changing hands. And so,
so fast forward to pre-deal. Did you guys still each own 50%? And then how much debt was on the books?
No, I had a 10% option thing that I had exercised. We had also taken out 12.5 million of dividends along the way.
Oh, wow.
And so we were both already in the money, if you will, on our original investment. The 2 acquisitions weren't financed with equity. They were financed with debt. So we didn't put more money into the business. We were only taking money out. And so, at the end of the day, we had maybe 6 or 7 million. Well, we also had 4 or 5 million of cash on the balance sheet when we did the deal. So net debt, we probably had a couple million.
Yep. Yeah.
We were very cash flow generative. As I said, we made 6 million the last year. And so, we probably had, we probably started the year with 9 million of debt. We probably paid off, $1 million or so. But we had 5 million of cash on the books from that year of pure profit.
So what was the sale? What was the sale price?
Well, you can sort of backwards in, and I'm not sure I'm allowed exactly to say, but like I said, the combination of the dividends and the price was just shy of 50 million.
Yeah. So is this what you'll do next? You'll go sort of run the same playbook. I mean, your cash exposure was about 2.7 million. It sounds like total when you guys bought the initial thing, and then the rest was creativity, good deal making, and a lot of patience. Is that what you'll do next?
Mm-hmm. I hope so. Listen, every deal has its own, it's not always the same playbook for each deal, right? It depends on the market dynamics, the growth trajectory, the competitive, you don't always control those things. And so, but I generally like acquiring, there's always things you can fix in a business. Sometimes it's as basic as actually make it a subscription business, which wasn't too hard to do, but wasn't being done for some reason. Not every fix is that obvious and that easy. But we look for things that are doing well in spite of some mistakes. Founders are sometimes really smart at some things, but not so good at other things. And so we try to find things that they've done really well, but still see issues that they've, where they left meat on the bone unwittingly because they're just not experts in everything.
Yeah. Which bank did you use in the first $3 million acquisition? I want to get a sense of what banks are friendly in terms of letting entrepreneurs like you use debt to do acquisitions.
So that was Webster Bank. This was before the days of SAS Capital and Later Capital and people like you. Now, that didn't really exist at the time. But yeah, Webster Bank, which was a local Connecticut bank. They were my bank in my previous company too. And so they were funding.
Is that a lesson here? Is that a lesson? I mean, most entrepreneurs are forced by their VCs to go bank with like Goldman or SVB, but you really can't have a personal relationship there like you had with this local bank, right? Isn't that an advantage?
SVB wouldn't touch us because we didn't have like a traditional VC in the deal. They would rather fund a company that's losing money with a brand name VC than, they don't do cash flow lending. It's like, well, but we actually have profits. They're like, well, we don't care about those. We, you don't have,
profits.
Famous.
Profits. What are profits?
So, we were getting basic kind of, 3.5 times leverage, kind of standard, debt to EBITDA stuff. And we had the EBITDA to do it. And, listen,
if that business was doing $1 million in profits, you could go raise 3x that in debt to fund the deal, $3 million. Yeah. At what cost of capital? Typically, like under 10% interest?
Oh, yeah, it was typically, LIBOR plus, nothing. I mean, It was like typically around 5%,
Wow.
But you have to pay back the principal, right?
Yeah.
And you have to make pretty hefty principal repayments.
Brad, how do I get on your next deal? How can I put up some cash and then let you do your thing with it?
Well, I'd love to work with you. I was thinking that very same thing. I would love to work with you.
Yeah, let's talk. I'm not as rich as you, but I'd put up 200, 300, 400 grand and let you do your thing and learn.
Yeah, I mean, I'd give you a huge carry because you're a really smart, knowledgeable guy about this business. So I wouldn't need your capital. I'd be happy to work with you just for your knowledge, know-how, etc.
Well, I love profits. I love founders with profits. You love operating companies with profits. There seems like a win-win here. Brad Miller, we'll see what happens. Thanks for taking us to the top.
And I'm serious. If you want to talk, hit me up on Slack. I am happy to figure something out with you.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com youtube.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.